But this other piece is interesting. You are very active in the community. And as we've talked about before, I mean, you've been doing this for over 4 decades, and you know everybody knows you. But just recently, as of this morning, you were in a meeting this morning. I'd love for you to talk a little bit about that, especially when it talks about, or when they talk about, hey, what part of the market is moving and why is that? And is that a clue for other parts that may be struggling?
Yeah, exactly. Yeah, I'm very involved with local industry events, Association of Realtors and Builders Association and so forth. And I was at a meeting this morning with the local real estate association. And we were actually talking, myself and another originator, friendly competitor. In fact, I even get invited to their holiday party every year. But her and I were talking to a title rep with a major title company, and we were just talking about what's going on in the business right now. How is business in terms of activity? And it was interesting. This title rep commented that things are still kind of slow. Of course, refinance activity very, very slow because of where rates are at. But even in the resale markets, certainly activity is not where it was before. And we've already talked about on this program how existing home sales have been soft and have declined somewhat over what they were. But what was interesting is she went on to tell us both that the part of their company that was pretty much doing very well was their builder division. And she goes on to describe that the reason for that is because in the builder division, the builders they work with are good at using financing incentives. She particularly and specifically mentioned interest rate buy downs as she believed, and I agree with her, as a factor that underscores why the new home market, even here locally in the Coachella Valley, is doing relatively well or doing better than existing home sales. And she touches on what I've been harping about for quite a while now. Builders are using financing to spur some of those sales. And to me, it was just underscored that message that I think in the resale markets, there's a little bit of a lack of focusing on financing, either when you're listing a home with the seller, you're getting a listing from a seller, or representing a buyer. For example, when a realtor is talking to a seller and trying to get that listing, it's my belief, and I think it was a little bit underscored this morning in this conversation, that there's not a lot of time spent talking about as they decide between the seller and the listing agent what they're going to list the property for, what price they're going to list at. They don't really talk about, I don't believe, whether or not they should contemplate financing as a parameter to consider and maybe settle on that final list price to take into account the possibility, or maybe even, I think they should more directly, a strategy to incorporate in that list price some amount of funds that would be made available as a concession to offer a financing incentive to a prospective buyer. And of course, the most obvious thing to do in a current high rate environment is to consider doing that, and right from the get-go, advertise that listing with some, financing incentive that will be compelling to a prospective home buyer. I mean, if, for example, if I'm a listing agent trying to get a listing from a seller, and we're talking about what do we need to list it for, we look at the comps, we try to figure out as best we can what the market is for that property, and let's say we decide it's $750,000. Well, I think what's lacking, and what I would do if I was selling real estate, not arranging loans, I'd be talking to that seller about, $750. Yeah, we think that's a pretty good price, but maybe we ought to play the game that builders do. Instead of listing at $750, maybe we ought to list at $779. And in doing that, we'll put right in the listing, seller is willing to offer a concession to finance the cost of a temporary rate buy down, such as a 3-2-1, and advertise in that listing how much that could save either in monthly payment or maybe just reference what the rate would be. I mean, for example, right now, the market rate for a conforming loan, well, we're at about 7.125, 7.25 range. Well, Consider if you were going to list a property and you've decided on your list price, it might make sense to pump up that list price a little bit to account for what the cost would be to, say, advertise a 3-2-1 buy down. So that way, what you're doing is right from day one, when you activate that listing, you're offering not 7.25. You're referencing the fact, hey, seller is willing to help you, the buyer, get a 4.25 rate first year. Well, on a price level that high, 750 or so, and let's say they're putting 20% down, the monthly payment benefit to the buyer with a 3-2-1 buy down is likely going to be over $1,000 a month.